Section B. Long answer type questions, 10 marks each. Note: these questions require theoretical depth and analytical structure. This section provides detailed, easy-to-understand explanations for the core concepts. Q6. Critically evaluate the net present value (NPV) and internal rate of return (IRR) methods of capital budgeting. Easy explanation. Both NPV and IRR are the gold standard for evaluating long-term projects because they use discounted cash flows (DCF), meaning they properly account for the time value of money. The question asks you to explain them and, more importantly, explain why NPV is the better choice. Net present value (NPV). What it is. NPV is the monetary difference between the present value of all money coming in from a project, cash inflows, and the money going out, cash outflows, including the initial investment. It tells you the net increase in the firm's wealth today. Formula: NPV equals N area summation, (1 plus K, caret T minus C0. Acceptance rule: accept the project if NPV is greater than 0, NPV greater than 0. A positive NPV means the project is earning more than the minimum required return K and adds value to the firm. Internal rate of return, IRR. What it is. IRR is the specific rate of return that a project is expected to earn. Mathematically, it is the discount rate that makes the project's NPV equal to 0. Acceptance rule: accept the project if the IRR is greater than the firm's cost of capital K. Why NPV is superior, the conflict. When companies have to choose between two or more mutually exclusive projects, they can only pick one. NPV and IRR sometimes rank them differently. In these cases, NPV is universally considered superior for three primary reasons. The reinvestment rate assumption. This is the biggest flaw of IRR. NPV assumption assumes that the cash flows generated during the project's life are reinvested at the firm's cost of capital K, which is a realistic rate. IRR assumption assumes that the cash flows are reinvested at the IRR itself. If a project has an IRR of 30%, this assumption is often highly optimistic and unrealistic, leading to inflated project rankings. Value additivity principle (NPV). If a firm undertakes two projects, the total value added is simply NPVA plus NPVB. NPVs are in rupees, or dollars, and can be added, directly linking the project decision to the goal of wealth maximization. IRRs are percentages and cannot be meaningfully added together. Multiple IRRs problem. If a project has unconventional cash flows, e.g., a cash outflow in year 3 for a major repair, the mathematical calculation can result in two or more different IRR values. When this happens, the IRR method completely fails to provide a clear decision. NPV always gives a single, clear monetary value. Q7. Discuss the determinants of working capital for a manufacturing firm. Easy explanation. Working capital is the money used for the firm's daily operations, current assets, current liabilities. The question asks what factors decide how much working capital a manufacturing firm needs. The amount of working capital required is highly influenced by several internal and external factors. Nature of the business, type of industry, impact. Manufacturing firms must buy and store raw materials, process them into work in progress, and hold finished goods inventory. This requires high working capital. Contrast. A service firm sells time and requires very little inventory, needing low working capital. Scale of operations, size. Impact. A larger firm with higher production volume and a wide distribution network will naturally require more funds to cover its higher levels of inventory, debtors, and daily expenses compared to a smaller firm. Length of the production cycle. Impact. This is the time it takes to convert raw materials into the final product. If the cycle is long, funds are tied up in unfinished goods, WIP for longer, requiring more working capital. A short cycle needs less. Credit policy, sales and purchases, credit allowed to customers. If the firm sells goods on liberal credit terms, its customers, debtors, will hold the firm's cash for longer, necessitating more working capital. Credit received from suppliers. If the firm's suppliers offer generous credit terms, this acts as a short-term financing source, reducing the firm's need for its own working capital. Seasonal variations and business cycle. Impact. Firms that sell seasonal goods require a peak level of working capital just before their season to build up inventory. During the off-season, the requirement drops sharply. Rate of inventory turnover. Impact. If a firm is efficient and quickly sells its inventory, cash is freed up fast, meaning the total working capital requirement is lower. Slow turnover ties up cash and requires more capital. Technology and automation. Impact. Highly automated processes can reduce the time inventory is held and may lower the need for liquid cash reserves. Conversely, reliance on manual processes might increase the need for cash to cover weekly wages. Q8. Explain the Walters model of dividend policy. Easy explanation. Walters' model argues that a company's dividend policy does matter to shareholders, and therefore it directly affects the value of the firm's stock. The key to the model is comparing two critical rates of return, R, internal rate of return, and key, cost of equity. Walters' formula, P equals D plus RK/ED divided K. Impact on firm value and optimal policy. Growth firms, R greater than K. The situation, the company can earn a higher return, R, by reinvesting earnings than the shareholders could earn themselves. Optimal policy, the company should retain 100% of its earnings. Payout ratio equals 0%. Investors prefer that the firm keeps the money and reinvests it, which maximizes the share price. Normal firms, R equals K. The situation, the company earns exactly what the shareholders expect. It makes no difference whether the firm retains the money or pays it out as dividends. Optimal policy, dividend policy, is irrelevant. The market price of the share remains constant, regardless of the payout ratio. Declining firms, R less than K. The situation, the company is earning less R than what shareholders could earn by taking the cash and investing it elsewhere. Optimal policy, the company should distribute 100% of its earnings as dividends. Payout ratio equals 100%. Investors want the cash back so they can invest it better, which maximizes the share price. Q9. Explain and illustrate the steps involved in calculating the payback period method of capital budgeting. Easy explanation. The payback period is the simplest, most fundamental method of evaluating a project. It asks, how long will it take for the project to generate enough cash flow to recover the initial investment? Steps and calculation. Identify cash flows. Determine the initial investment, C0, and the annual cash inflows, CORT, for the project's life. Determine recovered amount. The goal is to find the point where the cumulative cash inflows equal the initial investment. Case 1. Equal annual cash flows, annuity. Payback period equals initial investment / annual cash inflow. Case 2. Unequal annual cash flows. Payback period equals years before full recovery plus unrecovered amount cash flow in the following year. Decision rule. Accept the project if the payback period is shorter than a predetermined maximum acceptable period set by the management. Q10. Discuss the major factors that influence a firm's dividend policy, apart from the R versus key models. Easy explanation. While models like Walters and Gordon's offer theoretical answers, in the real world, many practical factors and constraints dictate how much a company pays out in dividends. Key factors. Legal restrictions. A firm may be prevented from paying dividends if it violates government laws, corporate charter rules, or specific loan agreements. Liquidity position. Dividends are paid in cash, so liquidity is paramount. A company might have high accounting profits, but no cash on hand. Growth opportunities. If a company has many profitable projects, it will prefer to retain earnings for internal funding rather than paying them out. Shareholders' expectations management often tries to maintain a stable dividend policy. Shareholders hate volatility. Access to external capital. If a firm can easily raise capital externally, it may feel comfortable paying high dividends. Taxation policy. The tax treatment of dividends versus capital gains can influence the firm's policy.